The Global Minotaur. Okay,
Uh,
that's an evocative image. It definitely grabs your attention. Is this just a catchy phrase, or is there something more substantial behind it?
oh, it's much more than just a phrase.
Yeah.
It's a really powerful metaphor coined by the economist Yanis Varoufakis. He developed this concept, I think it was back in 2002, drawing from years of conversations with his colleague Joseph Halevi.
Okay.
They were trying to make sense of what really made the world economy tick, especially after the huge economic shifts of the 1970s. Their talks focused on America's unique twin deficits, the growing power of Wall Street, and kind of paradoxically, the falling real value of American wages.
Ah.
So this Minotaur metaphor, it tries to simplify a pretty complex view of America's unique and, as we'll see, quite paradoxical role in the global economy after 1971.
Right. So, okay, if we're going to understand this Minotaur, we probably need to understand the world before it existed. What was the setup? What led to its emergence?
Exactly. To really grasp the Minotaur, we need to first understand what Varoufakis calls the global plan. You see, the United States came out of World War II as the dominant, well, really the only major creditor nation.
Right. Everyone else was devastated.
Pretty much. And this wasn't necessarily a role it sought out, but one that was kind of thrust upon it by the sheer devastation in Europe and Asia.
So the U.S., almost unwillingly perhaps, found itself in this position of shaping global reality. And this brings us straight to the Bretton Woods Conference in 1944. I always picture that scene, all those delegates in that New Hampshire hotel.
Yeah, blueprinting a new global monetary order.
Exactly. It was meant to stop another crisis like the Great Depression, wasn't it?
Precisely. And it was there that John Maynard Keynes, the famous British economist, put forward this incredibly audacious proposal. He envisioned an international currency union, ICU, with a single global currency he called the banker.
A single world currency. Wow.
Yeah, managed by a global central bank. And what's really fascinating about Keynes' idea is that it wasn't just about managing deficits. It also aimed to penalize surpluses.
Penalized surpluses. Why?
Well, Keynes firmly believed that persistent surpluses were just as destabilizing as deficits because they drained crucial demand from the global system. So this mechanism, it was explicitly designed to prevent future crises, a kind of global economic balancing act.
But the U.S., under Harry Dexter White, famously rejected that vision. As I understand it, White was absolutely clear. America wanted to keep its own surpluses and, crucially, control how global surpluses were recycled. No international body telling the U.S. what to do.
That's spot on. So instead of Keynes', cooperative global plan, the U.S. basically forged its own global plan based on its post-war dominance, hegemony. And this U.S.-centric plan involved a remarkable dual strategy.
Okay, what was that?
Domestically, it created the military-industrial establishment, the MIE, channeling huge spending into areas like aerospace, electronics,
Yeah.
keeping corporations happy and growing.
Right. And then on the social side, you had President Johnson's Great Society programs. These weren't just minor initiatives, were they? They were serious attempts to tackle internal social issues.
Absolutely. The Great Society included major laws to dismantle American apartheid, invested billions in education, healthcare. And the impact was pretty significant. The percentage of Americans below the poverty line, it dropped dramatically, from about 22% down to under 13%.
So it was a plan for both internal cohesion and external dominance. Sounds pretty grand.
It was ambitious.
Yeah.
But grand plans, well, they often come with grand costs. What started to unravel this whole thing?
Yeah, what wrong?
By the late 1960s, the combined costs of the Vietnam War, those Great Society programs, were really mounting. This forced the U.S. government to pile up massive debt and, critically, to flood world markets with dollars. And other nations, especially in Europe and Japan, started feeling significant inflationary pressures. They got worried.
I can imagine. Their fear must have been a run on the dollar, right? If the U.S. couldn't back its dollars with gold, and by early 71, its liabilities were way over $70 billion, but its gold reserves were only about $12 billion.
Exactly. Their dollar holdings would lose value.
Yeah.
The cracks really started showing in 1967. The British devalued the pound by 14%, triggering a crisis. The U.S. had to spend a huge chunk, like 20% of its gold reserves, just defending the dollar.
Wow.
It was a clear signal that the fixed exchange rate system, the whole foundation of Bretton Woods, was basically on the brink.
And unraveled it did. August 15th, 1971. President Nixon unilaterally ends the dollar's convertibility to gold. That must have sent shockwaves.
Oh, it was a massive shock. It effectively dismantled Bretton Woods overnight. But while it was dramatic, it wasn't totally out of the blue. Paul Volcker, who later became Fed chair, had actually been exploring the idea of suspending gold convertibility as early as May '71.
Really?
Yeah. In fact, Volcker's statement in 1978, where he talked about a controlled disintegration of the world economy being a legitimate objective for the 1980s, that was basically a pretty blunt announcement of America's new strategy.
So let me get this straight. The U.S. couldn't maintain balanced flows under the old system, so it decided to aim for an asymmetrical one instead, to keep its exorbitant privilege of running basically endless deficits.
Precisely. And this, for Yanis Varoufakis, marks the birth of the Global Minotaur.
Okay, this Global Minotaur, it sounds incredibly powerful, but still a bit abstract. Can you give us the nuts and bolts? How did it actually work day to day? How did it vacuum up these global surpluses you mentioned?
Okay, sure. The core mechanism was America's twin deficits, its trade deficit, buying more than it sold, and its budget deficit, the government spending more than it took in taxes.
Right, the famous twin deficits.
Exactly. And these two together acted, as Varoufakis vividly puts it, like a giant vacuum cleaner, just sucking in global surpluses. So countries like Germany, Japan, and later China, they'd churn out goods, cars, electronics, clothes.
Rich Americans would buy lots of them.
Avidly. And then this is the really crucial part. Almost 70% of the profits made globally by these exporting nations flowed back to Wall Street.
70%. That's an incredible amount of capital flowing back. And what did Wall Street do with all that cash?
Well, Wall Street then recycled this capital back into the U.S. economy through direct investments, buying U.S. stocks and bonds, funding businesses, and importantly, creating ever more complex financial instruments.
The financial engineering starts.
Exactly. And this system, even though it was fundamentally imbalanced, it paradoxically created a kind of global stability and growth for decades.
So this powerful global Minotaur needed some strong legs to stand on, presumably. What were the critical pillars holding it up?
Well, first and foremost, the dollar's enduring status as the world's reserve currency. Even after Bretton Woods collapsed, the dollar remained the go-to currency globally. It acted as a safe haven during crises.
Even crises starting in the U.S. itself.
Yeah, paradoxically, yes. Plus, all primary commodity sales, think oil, coal, grains, they're priced in dollars. This creates constant global demand for U.S. currency. As Paul Volcker once put it, external financing constraints were something that ordinary countries had to worry about, not the unquestioned leader of the free world whose currency everybody wanted.
That's a huge advantage.
Yeah.
A self-feeding loop of demand for dollars. It was a second pillar.
The second was what Varoufakis calls cheapened productive labor, right inside the U.S. See, from about 1973 onwards, even though U.S. labor productivity was booming thanks to new tech, working harder, foreign investment.
Right, people were producing more per hour.
Way more. But real wages for most American workers basically stagnated. They haven't even recovered their 1973 purchasing power today, according to the analysis.
Stagnated. For decades.
Yeah. And this stark reality meant profits soared for corporations, which in turn made the U.S. an even bigger magnet for foreign capital looking for returns. It was a key part of the Minotaur's allure, if you like.
Okay, reserve currency, cheapened labor. It was the third leg of this tripod.
And finally, you can't ignore geopolitical might. The undeniable military and political power of the United States played a crucial role in shoring up global confidence. This power essentially guaranteed, or seemed to guarantee, that capital flowing into the U.S. was safe, that investments would pay off.
So economic power reinforced geopolitical power and vice versa.
Exactly. A mutual reinforcement that was absolutely fundamental to the Minotaur's long reign.
Okay, so we've got this picture of this huge global Minotaur, this seemingly self-sustaining economic beast. But even a beast like that doesn't exist in isolation. It had allies or maybe enablers. You call them its handmaidens, right?
Sure.
What were these forces that not only fed its growth, but also maybe push it towards its eventual collapse?
Well, the primary handmaiden, no surprise, was Wall Street itself and its growing obsession with financialization.
Yeah.
The sheer flood of capital coming in, both from overseas and domestically, it just ignited this takeover fever.
Mergers and acquisitions going crazy.
Absolutely surged. Think Daimler-Benz buying Chrysler for $36 billion, only for the merged company to be valued instantly at an astronomical $130 billion on Wall Street.
Wow.
Or AOL, an internet company with basically inflated stock, using that to buy Time Warner, creating this giant valued at $350 billion. These were just stratospheric, often, frankly, fictitious valuations. And they eventually collapsed, right? Daimler sold Chrysler for just $500 million in 2007, losing $35.5 billion.
When I was reading through the material, the discussion around derivatives really stood out. They started out sounding quite sensible, didn't they? A farmer managing
Yeah,
risks.
hedging commodity prices.
But something fundamentally changed. How did they go from being useful tools to, well, the sources call them malignant tools for aggressive leveraging?
It's a really critical point. Derivatives sort of mutated. Instead of just buying an option to sell shares if the price drops, insurance, a hedge, the smart set, as the source calls them, started buying options to buy even more shares. They were basically borrowing huge sums to make massive bets.
So using borrowed money to amplify bets.
Exactly. Leverage on a massive scale.
Huh.
This wasn't just benign financial innovation. You might remember, after the 2008 crash, Paul Volcker famously quipped that the only truly useful financial innovation he could recall in his long career was the ATM.
Yeah, I remember that. Tells you what he thought of the rest.
Pretty much. So this wasn't just a sideshow. What was the real destructive impact of all this leveraging?
Yeah, what did it lead to?
It was, as Varoufakis and Halevi put it, an open invitation to print one's own money. This leveraging fueled the creation of what they call toxic private money, mainly in the form of collateralized debt obligations, CDOs.
CDOs, the infamous acronym.
Right. Imagine a bank taking all sorts of loans, good mortgages, really shaky subprime ones, and just bundling them all together, like ingredients in a financial sausage.
Okay.
They'd then slice the sausage into different layers, or tranches. And here's the kicker. They'd get credit rating agencies to stamp these slices, even the ones stuffed with risky loans, as AAA. Super safe.
Wait, even with risky stuff inside, they got the top rating.
Well, that's a whole other story about rating agencies, but yes. And that AAA rating allowed banks to essentially originate and spread the risk. They could sell these complex packages to pension funds, insurance companies, other banks all over the world as if they were as safe as government bonds.
So they weren't holding the risk themselves anymore.
Exactly. Think about the power of that. It meant this unregulated private money was just flooding the system, inflating asset bubbles, housing, stocks everywhere. Kind of mind-bogglingly, the scale of it.
Beyond Wall Street, the material also mentions the Walmart effect. This wasn't about complex finance, but something much more down to earth, right?
Indeed. Walmart and companies like it built their empires less on tech breakthroughs and more on really ingenious methods of relentlessly squeezing suppliers for lower prices and, crucially, hacking away at labor costs.
They capitalized on those stagnant wages we talked about.
Directly. They responded to a working class that desperately needed cheaper goods because their pay wasn't rising. And while this initially helped keep inflation down, Walmart's expansion also, paradoxically, often led to rise in poverty rates in the areas where it set up shop. By depressing local wages and pushing out smaller businesses, it was almost like importing third-world conditions, as the source puts it, into American towns.
And underpinning all of this Wall Street, Walmart was what the sources call toxic economic theory and trickle-down politics. Sounds like government policies and economic ideas were perfectly aligned with this whole Minotaur system.
They absolutely were. Political policies, the big tax cuts for the wealthy, the aggressive deregulation under Reagan and Thatcher and continuing after, they created an environment perfectly suited for the Minotaur.
The ideal habitat.
Exactly. And meanwhile, academic economic theories like the efficient market hypothesis, rational expectations, real business cycle theory, they provided a kind of pseudoscientific legitimacy. These theories basically painted a picture of capitalism as inherently stable, self-correcting, almost like a law of nature. They downplayed the very possibility of major crises.
So the models couldn't even imagine a crash like 2008.
Well, there was even this remarkable theorem mentioned, which basically said that mathematical economic models couldn't handle both time and complexity at once, meaning they were inherently incapable of simulating real-world crises. In effect, these theories essentially just assumed away the possibility of systemic collapse.
Right. So after decades of the Minotaur's reign, fueled by Wall Street, enabled by policy and theory, the system just became unsustainable. That toxic private money built on those huge capital inflows eventually just auto-combusted, as the source says.
That's the core of it. When that toxic private money essentially vanished, turned to digital dust, the world economy just crashed. And what happened next is what the material calls a prophecy paradox.
A prophecy paradox? What's that?
It's a bit like someone predicting doom, and then the actions they take to prepare for that doom actually cause it to happen. Logically, you'd think falling wages and super low interest rates would boost an economy, right? make things cheaper, encourage borrowing and spending.
Yeah, seems logical.
But in a crisis like 2008, it worked in exactly the opposite way.
How so?
Because if everyone sees wages falling and interest rates hitting rock bottom, it doesn't signal bargain time. It signals this economy is in deep, deep trouble.
Yeah.
So businesses they stop investing.
Right. They see those as bad omens for future demand, so they pull back.
Exactly. Leading to an investment strike, more layoffs, which then confirms their own gloomy forecasts. It becomes a vicious, self-fulfilling prophecy of decline.
Okay, let's just take a quick snapshot of how rapidly things unraveled then. It really was a cascade, wasn't it? 2007, you had the first bank run in the UK since the 1920s, at Northern Rock.
Yeah, queues outside the branches. Unbelievable.
Then, March 2008, Bear Stearns, the fifth biggest Wall Street bank, basically wiped out, absorbed by JP Morgan Chase with a huge taxpayer subsidy. Then, later that year, the U.S. government nationalizes Fannie Mae and Freddie Mac, the mortgage giants. Cost potentially $5 trillion.
Huge numbers. But the absolute pivotal moment, the one everyone remembers, came in September 2008. Lehman Brothers bankruptcy. Paulson's famous no, despite everyone expecting a bailout like Bear Stearns. And in that moment, it wasn't just Lehman that went under. It triggered the most dangerous avalanche of the entire crisis. Confidence just evaporated.
And it spread globally, fast.
Instantly.
Oh.
Major European banks started collapsing. Fortis, Bradford and Bingley nationalized. Ireland's government made that disastrous move guaranteeing all bank debts.
The error of the century.
Which effectively bankrupted the nation down the line. Then the U.S. Congress initially rejects the Paulson bailout plan. Markets plunged further. By 2009, even giant auto companies like Chrysler and General Motors were being nationalized.
Bear Stearns, Fannie, Freddie, Lehman, Fortis, B&B, Ireland, GM, Chrysler. It's just relentless, a complete meltdown.
That whole cascade, as you called it, led directly to what economists call a global liquidity trap. Interest rates plummeted to near zero across the West.
The situation Keynes warned about in the 30s.
Exactly. It's where traditional monetary policy, cutting interest rates, just stops working. People hoard cash, banks don't lend, businesses don't invest, and falling prices actually increase the real burden of debt, making the recession even deeper. But this time, it wasn't just one country, it was global.
And the sheer scale of the debt involved must have been terrifying compared to previous crises.
Wow, it was staggering. The U.S. entered the 2008 crash with total outstanding credit, public and private, at about 365% of its GDP. By 2010, it had rocketed to a stupendous 540% of GDP.
Oh, 540%.
Yeah. Compare that to the 1929 crisis, where it went from about 160% to 260%. The scale was just unprecedented, the Minotaur was critically wounded, possibly fatally, and the world was left grappling with this immense catastrophic fallout.
So, the Minotaur was wounded, maybe dead. But what kind of world emerged from that wreckage? The material describes it quite starkly as a bankruptocracy, a world where, paradoxically, failed banks after being bailed out by taxpayers ended up with even more political power. How on earth did that happen?
Well, a prime example given is the Geithner-Summers plan, put in place by the Obama administration in 2009. This was a $1 trillion package, ostensibly to save the banks drowning in those worthless CDOs we talked about.
Right, the toxic assets.
But instead of forcing banks to just write them off and take the loss, the plan created this kind of simulated market. Essentially, banks would set up their own hedge funds, often funded by previous government bailout money and special non-recourse loans from the Fed.
Non-recourse meaning the Fed took the risk if the assets were bad.
Precisely. And these bank-created hedge funds would then buy the toxic CDOs from their parent banks.
So wait, the banks were basically selling their trash assets to themselves, using taxpayer-backed funds, and the government was taking the ultimate risk. That sounds circular.
It was very circular. It allowed banks to get these worthless assets off their books without recognizing the losses, using massive government subsidies. It effectively legitimized the value of this private toxic money after the fact. And crucially, the public funds ended up flowing back into the bank's coffers, not really stimulating the wider economy directly.
Meanwhile, over in Europe, things weren't much better. The Eurozone plunged into its own crisis, described in the source as a simulacrum of the Minotaur's dynamic. What does that mean, a simulacrum?
It means it sort of mimicked the Minotaur's structure, but crucially, without the Minotaur's global recycling function. You had Germany running massive surpluses like the U.S. used to attract globally, but these surpluses were draining demand from within Europe, from countries like Greece, Spain, Ireland.
Because there was no mechanism to recycle those German surpluses back to the deficit countries within the Eurozone.
Exactly. Unlike the U.S. recycling global surpluses, the Eurozone lacked that internal mechanism. This led to huge imbalances. Then the European Financial Stability Facility, the EFSF, set up to help struggling nations, started issuing these toxic Eurobonds
Toxic Eurobonds, how are they toxic?
because they mimicked CDOs. They bundled together guarantees from different Eurozone countries, strong and weak, making it hard to place the real risk. This led to new rounds of unsustainable private money creation and eventually the sovereign debt crises that engulfed Greece, Ireland, Portugal, and others.
And the material seems to suggest Germany played a particular role here, perhaps being reluctant to push for a faster, more comprehensive solution.
Well, the analysis suggests that Germany was hesitant, perhaps, to implement quicker fixes like Eurobonds initially. And arguably, the ongoing crisis actually strengthened its bargaining power within the EU and allowed it to maintain its export-heavy economic model by effectively exporting stagnation to its neighbors. It created really deep, lasting imbalances within the Eurozone.
And what about Japan? It was already stuck in its lost decades before 2008.
Right. Japan had actually been contributing to the Minotaur's expansion before the crash through something called the carry trade investors, borrowing yen at near-zero interest rates in Japan and investing in higher-yielding U.S. assets. Post-2008, that Japanese condition, the liquidity trap, essentially spread globally as Western interest rates also hit zero.
And China, the rising giant, how did it fit in?
China grew enormously under the Minotaur's influence, supplying goods and recycling its profits into U.S. assets. But post-2008, even China struggled to generate enough domestic demand to keep its engine running smoothly, despite huge government stimulus. It also consistently resisted U.S. pressure to let its currency rise significantly.
Learning from Japan's experience, maybe.
Perhaps learning from Japan's experience with the Plaza Accord in the 80s, which arguably contributed to Japan's bubble and bust. The analysis you shared suggests that China, despite its size, couldn't, and perhaps still can't, fill the role of a new global demand engine, a new Minotaur. It struggles to absorb its own output internally.
So the really crucial takeaway here seems to be this. The Global Minotaur, as that functioning global surplus recycling mechanism we discussed, is dead, gone. While the U.S. still runs large deficits, its capacity to reliably absorb global imports and attract private capital in a stable, balanced way, that's vanished.
Exactly. The world economy now explicitly lacks that central recycling mechanism. The cry is, the global Minotaur is dead. Long live America's deficits. But the deficits no longer play the same stabilizing global role.
And in its wake, central banks tried things like quantitative easing, QE, the Fed buying mortgage-backed securities from banks. Was that just printing money?
Not exactly money printing in the way most people think. The funds created largely stayed within bank reserves. They didn't directly flood the real economy, leading to massive inflation, as some feared. QE was more like putting the patient on life support.
A temporary measure.
Yeah, a kind of cortisone, as Varoufakis puts it. It addressed the symptoms, slowed the decline, propped up asset prices, but it didn't cure the underlying disease, the lack of sufficient global demand, the huge debt overhang, the lack of a recycling mechanism.
Which brings us back to bankruptocracy. The argument is that these banks, bailed out by taxpayers, didn't just survive, they actually emerged with more political clout. How did that show itself?
Well, they successfully fought off or watered down meaningful regulation. Take the Volcker Rule, for instance, which aimed to stop banks that take government-insured deposits from making risky, speculative bets with their own money. It got significantly weakened. This new system, this bankruptocracy, is characterized by what the source calls rule by bankrupted banks. The financial sector exerts immense influence over policy, arguably hindering real recovery and stifling rational public debate about alternatives.
So the global Minotaur is gone. But its shadow, its wounds, they continue to plague the world economy, leading to this feeling of persistent insecurity, maybe stagnation. We've heard lots of observations about 2008 greed, bad models, poor regulation, and as you said, those are true.
They all played a part.
But as we've dug into today, only by understanding this bigger picture, the global Minotaur's rise and its death, can we really grasp the quintessence, as the source puts it, of what truly happened and maybe why the fallout continues?
And this really brings us to a profound challenge, doesn't it? Something for you, the listener, to really mull over. Without a new, effective global surplus recycling mechanism to replace the Minotaur, the world economy seems prone to prolonged stagnation, maybe even recurring crises.
That's a huge question hanging over us. Who could possibly lead the charge to create a new, functional global system? The analysis suggests, perhaps controversially, that despite all its own problems and divisions, the United States might still be the only actor capable of initiating such a fundamental, world-altering change.
It's a sobering thought.
It really is. It feels like a critical moment, doesn't it? One that will determine if our current era, the sort of postmodern 1930s, as some have called it, lasts for decades, or if we can find a way towards a new, more hopeful, and maybe more authentically human future.
A future built on cooperation, maybe, rather than controlled disintegration.
Definitely something to think about. Until next time, keep digging deeper.